This lesson takes a look at understanding your investment horizon and the potential impact of sequence of returns risk. Sequence of returns risk, in simple terms, means when a large bear market occurs in your investing lifespan. Sequence of returns risk naturally increases the closer an investor is to retirement, or a time when they actually need the access to their capital. Many investors will remember the impact of the global financial crisis, the GFC, of 2008, and what it did to their unprotected investment portfolios, particularly those that were coming up to retirement or were already in retirement. For others with longer-term timeframes, the GFC, whilst extremely newsworthy, was going to have a much lesser impact on their longer-term portfolio outcomes, simply because of the effect of time and the impact of compounding over the longer term. Retirement is the time in your life when income from paid work stops and you start to live off investments and their returns. At this time in life, many investors are still concerned about the impact of sequence of returns risk and what it might do to their investment portfolio returns now that paid work has actually stopped. And this is completely understandable. And in response to this, they become very risk averse. This has the potential to create significant financial issues if they continue to draw upon their investment capital, which is now experiencing much lower returns. Reason being, their capital is being consumed much faster than it can be replaced, and this means that their nest egg won't last as long as they originally thought, therefore potentially impacting on lifestyle choices and ultimately quality of life. It's a little-known fact that up to 90% of what's drawn down from your investments in retirement actually comes from earnings on your investments. And of that 90%, 30% comes from earnings during your working life, that is during the accumulation phase, and 60% comes from investment returns during retirement. Now, this is really significant because most investors completely underestimate what their investment horizon should be. And that's because their investing horizons tend to be closely tied to the date of their retirement. And from that point of view, completely underestimate what their real investing horizons are. According to the American Actuarial Institute, for a couple that reach 65 years of age together, there's nearly a 50% chance that one of them will reach the age of 90. So given that as a backdrop, it's worthwhile exploring some potential investing horizons. For somebody that's currently age 65, a female can expect to live for another 25 years and a male another 20 on average. For someone who's currently 55 years of age, a female is likely to have 35 years ahead of her and a male 30 years. So when considering those sorts of timeframes, somebody who's 55 might currently be thinking that their investing horizon is only 10 years, i.e. till the time at which they're about to retire, when in actual fact it goes well beyond that. So rather than a 10-year investing timeframe, they're realistically looking more towards 30 or 35 years. So what does that now mean about sequence of returns risk? Remembering, sequence of returns risk is effectively when a large bear market occurs in your investing time horizon. And that's not when you retire, but now much further away than you might have previously imagined. Looking critically at how bear markets recover helps us to understand their impact. It takes on average 6 years for a total return index to recover to its former bear market highs. So the question remains, if that was to happen, could you cope with the 50 to 60% fall in your portfolio value? And if you could, what would happen if you needed to draw down on the capital? Remembering, each time you draw down on that capital at that very low base, the portfolio returns actually need to increase above the recovery performance just for you to get back to break even. And that's going to make it much harder, and it's going to take much longer for your portfolio to recover. Timing is a risk mitigation strategy and will help to protect against those large bear markets and the impact of sequence of returns risk. So given that the investment horizons are now typically much longer than an investor might actually have thought, how can we ensure the growth still occurs, whilst at the same time keeping an eye out for that small dip that goes on to become a much larger one and then ultimately turns into a full-scale GFC Mark II, that is, an extensive bear market. So something to remember, the extent to which timing is not used is the extent to which your portfolio will experience the full brunt of the next bear market. So the question remains, given that your investing horizon is much longer than you may have previously thought, how can we blend both timing to protect our capital against sequence of returns risk, whilst at the same time continuing to grow the investment capital to ensure sufficient returns for the remainder of your investing time frame? That's something I'll address in the next lesson. Thanks for watching. We'll catch up with you soon.